This content is for educational purposes only and is not financial advice. Consult a qualified advisor before investing. Welcome back to Understanding Money. In today's deep dive, we're uncovering the 5 most common investing mistakes beginners make, and exactly how you can avoid them to set yourself up for long-term success. By the end of this video, you'll have clear, actionable steps and real-world examples to sidestep these pitfalls. If you're ready to invest smarter, hit like, leave a comment with your biggest investing challenge, and subscribe for weekly tutorials. Mistake number 1: chasing hot tips and market hype. It's easy to get swept up in the excitement when you see a headline proclaiming a stock will soar 1,000%. Perhaps you heard a friend rave about a penny stock that doubled overnight, or you saw a viral social media post hyping a new crypto token. But these quick win stories rarely pan out for the average investor. Chasing hype often means buying at the top of a bubble and selling in panic when the momentum fades. Real-world example. In early 2021, GameStop surged over 1,700% in days, fueled by social media and retail traders. Those who jumped in at the peak lost significant portions of their investments when prices retraced by more than 80%. How to avoid it? Commit to fundamental analysis. Examine a company's revenue and earnings growth over several years, assess profit margins, and study cash flow statements. Look for durable competitive advantages, like a strong brand or patented technology, that can sustain growth. Use analyst reports from reputable firms, but do your own due diligence. Remember, successful investing is a marathon, not a sprint. Mistake number 2: neglecting diversification. Putting all your capital into 1 or 2 stocks might yield big gains if you're right, but it also exposes you to severe losses if you're wrong. Imagine allocating 100% of your portfolio to a single tech stock, only to see its price drop 40% after a disappointing earnings release. Your entire portfolio would take that hit. Case study. During the 2020 market crash, diversified portfolios tracking the S&P 500 fell around 34%, while single-stock portfolios in severely impacted sectors like airlines or energy plunged over 60%. How to avoid it? Build a diversified portfolio across sectors: technology, healthcare, consumer staples, industrials, geographies, US, Europe, emerging markets, and asset classes: stocks, bonds, real estate. If selecting individual stocks feels overwhelming, use low-cost ETFs to gain broad exposure. For example, a total US market ETF covers thousands of companies in one trade. Diversification reduces volatility and smooths returns over time. Mistake number 3: timing the market. The allure of timing the market, buying at lows and selling at highs, is powerful. Yet research shows it's nearly impossible to do consistently. According to S&P Dow Jones indices, missing just the 10 best days in the market over the past 20 years can cut your total return by more than half. Example: from 2000 to 2020, the S&P 500 delivered an annualized return of about 7%. However, if you missed the 10 best trading days, your annualized return dropped to just 3%. How to avoid it? Adopt dollar cost averaging. Instead of waiting for the perfect moment, invest a fixed sum, say $100, at regular intervals, regardless of market conditions. This approach buys more shares when prices are low and fewer when they're high, reducing the impact of volatility. Most brokerages offer automated recurring investments, making execution effortless. Mistake number 4: letting emotions drive decisions. Fear and greed are 2 sides of the same emotional coin. Fear can lead to panic selling during market downturns, locking in losses at rock-bottom prices. Greed can push you to chase rallying stocks at inflated levels. Both behaviors derail your long-term plan. Psychological insight. Behavioral economists refer to loss aversion, where the pain of a loss feels about twice as powerful as the pleasure of a gain. This can lead to holding losing positions too long or selling winners too quickly. How to avoid it? Create a disciplined, rules-based strategy. Define your target asset allocation, such as 60% stocks and 40% bonds, and set rebalancing thresholds, like a 5% drift. Use automated rebalancing tools offered by many platforms to restore your allocation without emotion. Write down your investing plan and review it only on a predetermined schedule, quarterly or biannually, to avoid knee-jerk reactions. Mistake number 5. Ignoring fees, taxes, and other costs. Seemingly small fees and taxes can compound into significant drag over time. A mutual fund charging a 1.5% expense ratio may underperform a low-cost index fund charging 0.05% by over 1% per year. Over a 30-year horizon, that extra 1.45% cost can reduce your ending balance by more than 30%. Tax implications. Short-term capital gains on assets held less than a year are taxed at ordinary income rates, which can be 20-37% in the US. Long-term gains receive preferential rates, often 0 to 20%, depending on your bracket. How to avoid it? Opt for low-fee ETFs and index funds with expense ratios below 0.1%. Use tax-advantaged accounts like ISAs, UK, Roth IRAs, US, or other local equivalents. Hold assets for more than 1 year to qualify for long-term capital gains rates. Employ tax loss harvesting. Sell underperforming assets to realize losses that offset gains elsewhere in your portfolio. Putting it all together. Your expanded action plan. Solidify your foundation. Build an emergency fund covering 3 to 6 months of expenses and pay down any high-interest debt to avoid forced liquidations. Research and select. Use both fundamental and qualitative analysis. Dive into annual reports, attend earnings calls, and follow reputable financial news sources. Build a diversified core portfolio. Allocate 70% to broad market ETFs covering US and international equities, 20% to high-quality bond ETFs, and 10% to alternative assets like REITs or commodities for added diversification. Implement dollar cost averaging. Set up automatic monthly transfers to your brokerage, reinforcing discipline and reducing market timing risk. Establish emotional safeguards. Document your investment policy statement, automate rebalancing, and schedule periodic reviews instead of daily checks. Optimize costs and taxes. Audit your expense ratios annually, consolidate accounts where beneficial, and consider tax-efficient strategies like holding tax-inefficient assets in tax-advantaged accounts. Before we wrap up, a quick reminder. I'm not a licensed financial advisor. This video is for educational purposes only. Always consult a qualified professional before making any investment decisions. Past performance is not indicative of future results. If you found these insights helpful, please tap the like button, share which mistake caught you off guard in the comments, and subscribe to Understanding Money for more expert guidance. Thanks for watching, and I'll see you in the next episode.